Hi. Today let me walk you through a sort of case study of how we decided to be overweight a sector, what considerations went into it. So we have been overweight the capital goods and industrial machinery sector since October of last year. And this was flagged by our systems, of course, but let me just go back into the logic going into those systems. One, of course, it was a beaten down sector. Since 2007, which was its earlier peak, it had been underperforming very substantially in the decade of 2010 to 20. While the Nifty compounded nearly 9.5%, this sector compounded only 2.5%. But just because it is beaten down, that can go on for a long time. Just because a sector is not doing well doesn't mean it will start doing well from tomorrow. So what changed was on the demand side. There were a few positive movements. The government brought out its production-linked incentive PLI scheme to boost domestic manufacturing. The government itself upped its capex, which has been the main driver of GDP growth in the last 2 years. Then also the China Plus One strategy also helped certain sectors, and there was a demand uptick. Number three, these companies had gone through a very bad period of demand and therefore had cut out a lot of the flab. They were lean, mean, fit. So once the demand came in, the boost to earnings was disproportionate. So you saw earnings going up, you saw valuations going up, with the result from October last year, October 2021, when we went overweight, to August this year, whereas the Nifty went up only just about 1.8%, this sector went up 20.8%. And several stocks that we bought went up 2 to 4 times. So the stocks we bought included, CG Power, LG, SKF, and many others. I just wanted to give you a case study of sector that we picked where things went very well. Of course, we look at all our picks every quarter, so not everything that we think will do well necessarily does well, and we might revamp somewhere along the way. So hope that helped.